Hey, buddy, happy Friday. This is Bob from Trade Genius. Got my good friend Phil here. They're up to their dirty tricks again. Let us explain to you. Stay tuned.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening. Okay, Phil, this is absolutely hilarious. Whenever you start seeing a trend and it's in the financial news, get ready for the opposite. I'm going to throw it to you. You want to explain to them what it is?
Yeah, so it's funny because here's a shot of the Bloomberg terminal, which if you guys don't know what that is, it's what most of the professional investors use. It's not cheap, but it allows you to bring up any data that you want far beyond what you could get on something like TradingView or some other charting package. I mean, this literally has everything that you could chart. You can come up with your own symbols and things like that. So it's a very comprehensive tool. They're able to get news headlines immediately. And just a quick snippet here of just all the soft landing news headlines on the Bloomberg terminal over the last couple of days. So you can see, I'm sure most of our audience realizes that, what you see in the mainstream is what they're wanting you to see. But it's interesting to see how much soft landing headlines are hitting. And if you look back in time, and Bobby, you found this one and it ties in nicely. Soft landing hopes and hard landing realities. So isn't it interesting that the number of news articles mentioning soft landing, this isn't a new term. This has been around for decades, always precedes a U.S. recession. I thought that was pretty ironic.
Yeah, look, they're always trying to position you into an environment where they could sell to you.
Yep.
And the other thing we're starting to see too is this early stage of a new bull or a new economic expansion. We're starting to see those words too. That gets you in the wrong sectors at the wrong time. We're really late cycle right now, and they want to start positioning you in early cycle stocks, and because they want to get out of them.
Right.
And so that's the other thing we have to be really careful about too, Phil. And here's why it's such a joke. You want to throw your next slide up here? This one blew me away when you posted this one. Look at the current 10-year yield rate. The market fair value should be about 15.5 price to earnings ratio. We're sitting at 19, and the Mag 7 is sitting at 30. That means that the price of the average shares in that is 30 times the earnings that they're producing. And you remember, that's just earnings. That's not cash earnings. And that means that literally, if it doesn't grow, it would take you basically 30 years to generate the cash you need to pay for that if you're doing a private transaction. So this is hopelessly overvalued, Phil.
Yeah, I mean, and the CTAs, all the trade advisors, they're basically forced, it's like buying begets buying, because if they're not into the Mag 7, then and a lot of these guys are lagging this move. And that's why I think we've seen the number was quite large. I think it was 60 or 70 billion in the last trading days, primarily from CTA flows, which are commodity trading advisors. These are guys that are actively managing clients' portfolios. They're notorious for lagging, and they're more momentum traders. But if you're lagging and you're a momentum trader and you're trying to play catch up, you don't really care about the rest of the market. You're going to be chasing that alpha that's in the Mag 7. So I think this is going to continue to skew. Now, remember, the higher they go, the harder they fall. So your drawdown exposure on the Mag 7 is going to be higher. And where that matters is when these end of year flows change. So on one hand, we have a lot of bond issuance that still has to come. And we saw a little bit of that in October because we had a long hiatus where we didn't have a lot of long end bond issuance coming out. It was mostly T-bill stuff, short stuff that gets turned around and turned into short-term leverage into the markets. Once that first wave hit, we did see basically a decent sized pullback, right down to 4,100, even though the reverse repo was drawing down, which is generally liquidity bullish for the market. But we saw a little bit of a divergence there. We're going to get into some more bond auctions next week. We had a hiatus here, and I think the markets that also helped the markets, because if they're not doling out long bonds, then where's the market going to go? Well, it's going to put liquidity back in the system. And I think that's part of what we saw too, on top of the CTA flows that came in. So now we're going into, we have long bonds coming back online, long long bond auctions next week and the following week. So we're probably going to have a little bit of a pullback. But that being said, we're going to have now, because of where the market is, as we get toward the end of the year, we have all of this positive market. It tends to make for a positive December. Historically, that's just what happens. What it does, though, is it makes for a negative January. And that's where all the flows change. Okay. So when I say flows, this has to do with market positioning, call positioning, put positioning, option, the derivative market. And that the way that skews the market drastically changes come January. So most likely, Bob, what I think is going to happen, and I wasn't really that bullish into the end of the year, but given where we are and that we're going to have a positive year, unless something blows up here in the next couple weeks and the market tanks, right? Because that's what it would take. It would take us to retrace this entire move back down. If we don't see that, we'll get this push. And then the first week in January is typically rolling all of that leverage from the previous year's gains. So you're going to extend that probably into the second week. Then it's going to seem like things got turned off, because also you're going to have that long bond issuance coming on again with more long bond auctions. Remember, that goes all the way through Q1. So seasonally, you're a week into March. And a lot of times that's where we'll see a credit event. That's what happened last year. We had Silicon Valley Bank blew up, market dropped, and then got, rescued because the Fed opened up another liquidity window to bail banks out. And that window hasn't closed. It hasn't really dropped. And I suspect they'll probably tap into it again. So we may go into a thing where we get a kind of a nasty pullback, and then they'll come in and do some more liquidity injection. But at that point too, then you also have to look at macro. Are we going into a recession at that point? My guess is we're going to get a lot closer than we are now. And we're seeing all the data. You guys have seen it, ad nauseum about how things are weakening, jobs weakening, shippers are weakening, trucking's weakening, all that stuff. So that's where I think this is all headed. But it's funny that we're getting the narrative that this playbook's been in play for decades now. And it almost just confirms the reality that, the recession's coming. They're feeding us the narrative. And I'm sure the Fed's in on it too. They've been talking soft landing as well. So I'm sure they help these news flows, because it's like they said, that's why they target 2%, because they literally say, if you think 2% is a good inflation target, then that's where we'll end up. And they think that that's a happy medium, and it's all psychological. So psychologically, they don't want everybody freaking out. They want everybody thinking it's a soft landing as we slowly segue into a recession. And then they want you to realize it's a recession after we're in the recession, and then we can start getting out of it.
Yeah, and it'll be a long one too. So guys, interesting to hear your thoughts on this. Same old dirty tricks and market overvalued. And we're coming to the end of the year, so we'll probably have 6 weeks left of this bull run. And then it's going to be a pretty nasty 2024. A lot of things are converging. With that, you guys have a great weekend. We'll be back with you tomorrow with a podcast for the weekend. Enjoy yourself and enjoy the long weekend, all 2 days of it. Thank you for listening.
Trade Genius.